recording this call, and we are still waiting from one panelist who hopefully will be joining in very soon, and then we will be able to start in 2 minutes. Welcome everyone. For the new people who have just joined the call, I would kindly ask you to mute yourself if you're not a speaker today. And then I would also like to invite you to write in the chat where you're dialing in from. So which city, which country. Very curious to hear who's joining us today. And I see our second speaker is in the call right now. Hello, Funké.
Hello. Sorry, I just realized it's so dark in here, so all you can see is my shadow, so I'm just going to move seats.
Yes, of course, no problem. Welcome, everyone. I will ask you to please kindly mute yourself, and also, if you would like, write in the chat where you're dialing from. So I can see someone joining from Chicago, Leeds, Bangladesh, New York, Hong Kong, India again. Very exciting. Welcome, everyone. Super. I see a few people joining from India, Chicago heading to Barcelona. That's really exciting. I'm sure you're going to have a great time there. Okay. Perfect, Funké. So you found a good spot.
Yes, I did.
All right. Okay, I think we can slowly start since we have all of the speakers now. And for anyone who just joined, I will kindly ask you to mute yourself so that we don't have any background noises. And we can start the call now. So welcome everyone. My name is Nina and I will be facilitating this panel today on climate risk together with Daniele. So this event is brought to you by Brightest in collaboration with Allianz Commercial with two very special speakers who are Chris Bolman and Dr. Funké Adeosun. So we'll start by introducing Chris, and then I will give the floor to Daniele to introduce Funké. So Chris is an entrepreneur, writer, and advisor focused on sustainability. He is the co-founder and CEO of Brightest, which is a B Corp technology and advisory firm focused on sustainability strategy, data excellence, and compliance. And so with a background in technology, innovation, and sustainability, Chris previously worked in renewable energy at Photon Consulting and was a recognized United Nations Sustainable Energy Practitioner. And Chris was also a 2021 Impact Hub New York Fellow, and his work in writing has been featured in publications such as the Harvard Business Review, the New York Times, the Washington Post, and the Scientific American. So that's for Chris, and then I leave the floor to Daniele to introduce our second speaker, Funké.
Thank you, Nina. So Funké is a recognized sustainability expert. She has experience across different sectors, energy, chemical, and insurance one. And she's a sustainability and environmental engineer, and she has worked at the intersection of business, technology, and sustainability to develop different solutions to drive meaningful environmental impact in the world. Currently, Funké is our Allianz Commercial. She's our global sustainability practice head. So she leads the sustainable solution team. And in this role, she integrates ESG principles and sustainable practices into our insurance offering, focusing on resilience and the transition to cleaner, greener, and greener technologies for our clients. She's a proactive advocate for diversity and inclusion, and she's also one of the key members of our Allianz Grace employee network, where she mentors for African students displaced by the war in Ukraine. Nina, back to you.
Thank you for the great introduction, Danielle. And I think we have two wonderful speakers today, a lot of expertise. So very excited to hear from both of you. And I would like to remind all the participants, so there will be a Q&A at the end of this presentation of this panel discussion. So if you have any questions that pop up, anything that you would like to ask Chris or Daniele, feel free to write them in the chat, and then we will do our best to cover all the questions. So we will start with Chris, who will tell us a bit more about climate risk. The floor is yours, Chris.
Yeah, thank you, Nina and Daniele and to Funké and everyone here today. It's great to see so many of you. So I'm just going to start off by kind of talking about climate risk at a more broad or kind of high level, introduce the topic for anyone who's perhaps newer to this, and then we'll get more into kind of insights and best practices and applications as well. So I think as most people know, climate risk is really the consequences of the society that we find ourselves in today. And, climate risk, you can look at it in various different ways, but essentially it is, the risk of climate change and how it can impact businesses, assets, your daily life. And obviously, it also takes different manifestations, and there are different categories or ways to classify climate risk. So one of the most common ways to classify it is essentially looking at physical risk, which would be the actual acute manifestations of severe weather, drought, water shortages, wildfires, and other things that we're kind of seeing happening in the world that can create, again, risk for businesses, for cities, for entities, and really for society overall. So, just in the past week or so, we saw a very tragic kind of glacial collapse or landslide, which buried the town of Blotten in Switzerland. The UK, the southern United Kingdom, is dealing with sort of water shortages and historic dryness. We've seen wildfires in California. There are currently wildfires in Canada that are actually affecting the air quality in New York, where I'm at right now. So, this is really something that is happening around the world. And again, I think it's sort of a normal facet of life that shouldn't necessarily be normalized or accepted, but it is something that organizations have to prepare for. And then kind of beyond the acute physical risks of climate change, there are also things like transition risks. So as our economy adapts to climate change, as we adopt more sustainable principles, things are going to change. Insurers, for example, which I think I'll let Funke speak to more, are thinking about different standards and new criteria for how they want to underwrite risk and how they might want to approach that. Technology is changing, policies are changing, consumer preferences are changing, and a lot of people are demanding more sustainable products and services. Even many companies that are trying to, reduce their emissions or reduce their climate impacts are now looking to their suppliers or to their partners and thinking about how they can work together on these projects. So at Brightest, we primarily work with businesses and also sometimes with governments and universities around climate risk. And so, if you're approaching this for the first time, or if you're an organization that is newer to measuring this, or if this is something that you're thinking about in your studies, generally, this starts out with kind of essentially a data or a research-driven process. So you want to think about, where you're based, like, again, where are you physically located, where are your offices, maybe where's your home, where are manufacturing sites, all these different things. So you have physical locations of your kind of direct operations. And then you also have your value chain. So where are your suppliers based? If you're sourcing raw materials, where are your raw materials coming from? And, climate risk analysis is essentially an exercise, and again, a very sort of research and data-driven exercise in trying to understand, what are the risks today? And then how will those risks evolve in the future? And how can you potentially adapt and prepare for those? So in our work at Brightest and working with different organizations, there are a variety of different data sources that you can use. So there's satellite data, weather information. Organizations like, for example, the World Resources Institute, or WRI, has a tool called Aqueduct, which provides very good data on like water scarcity and water risk. So you can kind of find and integrate and synthesize these different data sources together and essentially kind of create maps or overlay them on where you are or where your company is and the places that you're doing business. And from there, you want to look at or think about, again, potentially different forecasts and different scenarios. So a common set of scenarios that many organizations look at would be the United Nations and sort of the IPCC, which has different scenarios around global warming. What will the world look like, and what will the economy look like if the world warms to 2 degrees Celsius or 4 degrees Celsius, mean global temperature, and what will that mean for, again, different regions, different organizations, and different segments of the environment. So, that's kind of a starting point that a lot of organizations will initially work from. And again, may also want to extend that to their suppliers, to their partners, and if you have a physical supply chain, where you're sourcing from. So if you're, sourcing wood from a specific region, is there wildfire risks for that? Or if you're sourcing physical commodities from a certain country, what could happen with the weather or with warming or other things that might create sort of risks for that. And then as an organization, you want to plan different scenarios, different contingencies, and different adaptation methods. So maybe, you're doing a lot of collaboration or sourcing from one region, which has very high climate risk. Maybe there are other regions with lower risk that you might want to think about diversifying your sourcing from. And obviously, there are kind of unfortunate like geographic consequences and implications. So, the closer you are to the equator, the more likely that global warming is going to impact and create, again, issues like droughts and water scarcity, and issues that will impact, agriculture, food availability, and other aspects that, obviously people as well as companies depend on. Whereas typically when you go, further north, if we're talking about Scandinavia or Iceland or northern Canada, typically climate risks are going to be lower, but not necessarily zero. Again, even in places relatively far north, we've seen wildfires, we've seen other issues. So again, it's kind of almost a matrix of thinking about the different potential dimensions of climate risk, thinking about the different data sources, the type of work that you're doing, where you're based, and how you integrate all of that together to create a picture, again, of where you are now, what are the risks that you need to deal with today, and how will those risks evolve over time. So that's kind of a general, hopefully introductory kind of precursor to climate risk. And I'm happy to sort of see if anyone else wants to expand on that further, or pass it to Funké if she wants to comment on this more.
No, I think you've done a really good job and given us a really good overview of what climate risk is from a global perspective, but also from an industrial perspective. So yeah, happy to move on to the next bit.
Cool. Well, I guess maybe one additional thing that I'll just say, as we sort of take it further. So I think now that we've kind of defined climate risk, I think one question is, okay, so like, why is this particularly important, and why is this timely, and why do organizations need to be thinking about and need to be working on this? So again, as I mentioned, I think there's just the reality of the fact that this is happening. It's happening on an ongoing basis, and these risks are very real. So, for example, we've seen insurance risks related to coverage of coastal properties or regions where there are wildfire risks that can actually damage like physical infrastructure. Or we've seen, examples of risks with shortages of goods and services, or raw materials that might, again, drive up inflation or prevent an organization from actually, manufacturing or producing and selling goods. at the quantities or volumes that it's looking to do. So there's the kind of direct like physical and business manifestations. And then there's also kind of an increasing or mounting set of regulatory considerations and frameworks and standards around this. So, for example, in Europe, Europe introduced the Corporate Sustainability Reporting Directive, as well as some other laws and regulations like the Corporate Sustainability Due Diligence Directive or the CS-DDD. And a lot of these regulations kind of focus on the materiality of climate change and climate risk. And we're starting to see a lot of organizations in Europe kind of reporting on their climate risks, their emissions, and their performance for the first time. In the United States, the state of California has introduced a new set of laws that actually essentially take effect this year. So this is SB 261, SB 253, and this is actually starting to require large companies doing business in California to start reporting on their climate risks to the California state government. There are also other kind of more international frameworks and standards, like, for example, the ISSB, which is the International Sustainability Standards Board. The ISSB has kind of evolved out of the IFRS, which is the International Financial Reporting Standards, which governs how organizations in a lot of different countries around the world report their financial performance. So if you've ever seen like a 10K or a 10Q or like an annual financial report, a lot of countries and a lot of jurisdictions kind of rely on the IFRS's financial reporting standards. So the IFRS has now introduced sustainability reporting standards, and that those standards have integrated existing frameworks like TCFD, the Task Force for Climate-Related Financial Disclosure, which is already in use in the UK and other countries as well. And so we're also starting to see companies adopt the ISSB and adopt climate risk reporting in ISSB sort of S2. So essentially, stakeholders are asking for climate risk reporting more. Various governments around the world are asking for this. Investors, particularly kind of institutional investors that are climate minded, are starting to ask for this as well. And, a lot of organizations are now, looking at kind of the world that we're in, looking at kind of the stakeholder demands and the inquiries and questions that they're getting, and understanding that one, it's very important to understand your own climate impacts, like how much energy are you using, how much carbon emissions is the organization generating, what is your potential transition plan or decarbonization plan to reduce your own climate impacts, and then what is the organization's overall like governance, strategy, and planning around handling and dealing with climate risk.
I think also on that note, just to jump in, because looking at it from an insurance perspective, and specifically from Allianz's perspective, we're a global company, which means that the regulations that Chris has mentioned, they have different dimensions globally. As a company that interacts with its clients in different jurisdictions, there is the international regulations that you need to, abide by, but then there's the local regulations when it comes to the provision of insurance itself. And when it comes to decarbonization and climate change, the interaction of society with these problems that are global is different. So depending on where you are in the world, regardless of the regulation, the local reaction to climate change differs. So in places, close to the equator, for instance, where this impacts are more acute, people have a present danger, if you like. So it makes them more aware of these risks. That doesn't necessarily mean that it's connected to the bigger picture of what's going on, but fundamentally, these areas around the world, there is a bigger understanding that these risks are here, they're present there now. Whereas in other places around the world where, they're further away from the equator, as you said, the risks are a bit less acute. It's a more of a chronic, maybe long-term risk. So what that means in terms of insurance is that the perception of who should be bearing the cost of insurance or the increased risks of premium is different, because the people that are experiencing the risk most acutely are not necessarily the same regions that contributed to the existing situation where we are now. So the more advanced you are, as a region or as an economy, you've probably contributed more historically to climate change or global warming than those areas who are facing most of the risk now. So the people who are bearing the risk are not necessarily the ones who are responsible for it too, but the people who need to pay, and the people who pay in terms of their daily lives are those that are acutely affected, but they're not necessarily the ones who have the money or the technology or any other thing that insurers would be interested in insuring to be able to mitigate and deal with those risks. So it falls on the areas which are in the advanced economic zones to take on this role and do more. But when it comes to business and insurance, it is important to understand that there is a difference between what you can do from a climate perspective and what you can do from a business perspective. So the key in our business specifically is to say, how do we turn the language of climate change, the language of sustainability, to a language of climate risk? So insurance is about risk. How do we make it about risk? And then how do we quantify that risk? So things like understanding, where an organization's emissions are coming from, what are their fuel sources, what are the areas where in the supply chain where there are risks, and then quantifying that in terms of how that risk relates to other similar companies that we insure in that space. So from an insurance perspective, is about breaking everything down back to risk, because fundamentally that's what we can price and that's what we know the best about. So that makes my job in many cases pretty unique and very varied. And it's also the reason why we have this collaboration with Brightest, where we are focusing on how we can help our clients understand where their emissions are coming from and potentially how you can mitigate it. Because being more energy efficient means knowing exactly where the sources of emissions are. And then if you can measure it, then you can reduce it, you can manage it. And that means that we have more sustainable clients, more sustainable businesses for the future. And it means that you're spending less money, on energy potentially at some point, which is good for everybody. So we try and, leverage the language of risk, the language of, doing what is right for business continuity and sustainability in the future.
Yeah, I think that's an excellent point, and that's something that we've seen as well. And one of the reasons why I think we're excited to be collaborating with Allianz is, a lot of the things that we're talking about have like very direct social consequences. Again, there's like a very significant, moral, ethical, and humanitarian lens to this, which is, the negative and acute impacts of climate change, again, in sort of drier regions and warmer regions and like coastal or island regions. It's already impacting tens, if not hundreds of millions of people. And so there's a very significant kind of humanitarian or human cost to this. But often what makes organizations or businesses make decisions, companies have shareholders, they have profits, they have losses. They often have to make these decisions in financial terms, or at least consider sort of the financial consequences of these decisions. And I think where you get the most leverage and the most value is really showing that this is kind of a double bottom line benefit or decision set, where you're creating kind of social impact and social value by adopting sustainability, but you're also reducing risk and creating financial benefits for the organization as well along the way. If you are reducing your energy consumption, as you said, that's efficiency, and efficiency is good for business. It means better operations. Or if you're improving your logistics, maybe you're burning less fossil fuels through transportation or vehicles. Again, you're saving money and you're also reducing emissions. So it's very, very important that organizations can kind of map and identify where these hotspots are and really understand how their business works from a sustainability and a climate perspective. But often once you get into having these conversations with organizations, they actually start to realize that, oh, there are significant like financial risks to us not taking action. And if we are thoughtful and we are diligent about this, there are significant financial benefits to us from taking action. And I think it's really that like financial or business case and that, again, kind of double bottom line win, that's something we're really excited to pursue and something that we're seeing resonating, that kind of goes above, I think, some of the political discourse or some of the cultural discourse around this and just makes it very clear where business needs to go and where the economy needs to go in order to transition and try to mitigate some of these challenges.
Chris, there is a question in the chat, maybe it's more for Funke, from Ali, which is the contribution versus impacting the relevant in the risk reviews and assessment? So I think, but Ali, feel free to step in to clarify. I think you mean like contribution to the climate risk versus the impact that you get as an entity from climate risk relevant for the risk assessment.
Yes, I was just picking up on the comment around being mindful of who's contributed to the conditions and the emissions versus who is getting impacted, like developing countries. But I didn't know where that fits in terms of a risk review or assessment. Is it even, is it just be mindful or is it relevant?
Yeah, that's a really great question. In terms of the risk review we do from an insurance perspective, it doesn't really feature per se because we look at all risks on on almost like an equal basis. We have to do that for all sorts of regulatory reasons. But fundamentally, I think when it comes to those areas around the world where they are most exposed to some of these risks that we are seeing that are manifesting all the time, they're not just confined to emerging economies. I mean, there's the California wildfires in recent times. There's been the floods in space. So they are happening everywhere, all over the world. What this means is that the areas where there's actually a lot more insurance penetration, which tend to be the advanced economies of the world, the cost of insurance is going up. So it's about understanding how that impacts them, regardless of who's contributed or not contributed. But fundamentally, it's now coming home to roost. So the cost of insurance is going up for everybody. But in those areas where they are most exposed to in emerging economies, what can we do to increase the insurance penetration in that area? So it's about understanding from an insurance perspective, where can we play the most part? Not about, litigating what's happened in the past, but learning from what happens here, transferring it over here, and then using whatever the cultural norms are in those areas to get the right types of insurance. So it might be parametrics, it might be public-private partnerships, it might be microinsurance. It's different, but it's about using what we know to kind of penetrate in those areas so that we can build the resilience globally. Because building resilience in one area and abandoning another area, that just causes a lot of instability in terms of people's movements around the world, again, which is very expensive for everybody. So the role of insurance is almost like a stabilizer across all of the measures that you can think about in this space.
Thank you. Yeah.
Fantastic answer, Funke. Thank you so much. We have a question, I believe, coming from the US. So I think maybe we can ask this one to you, Chris. And the question is, what assets can I bring or what story can I tell internally when I get pushbacks around climate initiatives and they did not want to be targeted by Trump's administration?
Yeah, so I think this goes back to a little bit of what I was just saying generally, which is I think there's a language to be used in political climates that are maybe a bit less favorable to kind of direct sustainability, climate, or ESG conversations, where, if an organization goes out very publicly in the United States and talks a lot about climate or sustainability, there is potentially a risk of business backlash. But, if an organization sort of couches that around operational efficiency or business transformation, those are very essentially kind of neutral words that can functionally be synonyms for exactly that type of thing. So, it depends a little bit on kind of how you're talking about or how you're messaging these conversations internally versus externally. But we've seen a lot of organizations, again, even in maybe more conservative areas or more conservative industries, have very productive kind of initiatives and dialogues and action plans around these areas by, again, kind of framing them in terms of, financial benefits. So if you, for example, kind of go through and do an energy audit of all of your sites, and you have a clear sense of kind of how much, energy is being used, natural gas, electricity, various different fuel types. And then you can start to look at these things in terms of like intensity. So maybe, energy usage per square foot or square meter, or energy usage per other KPI. You can start to identify, again, maybe places where you're less efficient because the building's older, or you're in a specific region, or maybe energy costs are higher because of the grid that you're on. And then you can start to say, okay, like what could we potentially do about that? Could we bring in external resources to help us reduce that? And that's a conversation that like gets CFOs to the table, because if you say, hey, we're spending, $10 million a year on energy, and I can reduce that by $2 million, and the CapEx and the payback on that is relatively quick, like that's a great conversation to have. And I don't think anyone's really going to bat an eye, or try to politicize that conversation. So, typically we've seen good results, again, when you're in kind of politicized regions or politicized spheres, focusing on efficiency, focusing on risk, and really making it about that can be a way to drive things forward. Like again, another example, and not to sort of go into any specifics, but like, we've seen a lot of information requests from larger companies directed toward their suppliers and their partners. So a very, very big global organization that, has to deal with UK laws and European laws and laws in the Asia Pacific region and various different jurisdictions. They can't only look at US law as kind of the guiding principle. And so that organization might be going to a component supplier or a service provider in the United States and saying, hey, we have these sustainability initiatives. We have this kind of broader global ecosystem of laws and regulations that we need to look at. Like, we need to work with you on this. Like, what are you currently doing? And so again, there might be like a revenue or an account risk or a business imperative to that US company that might not otherwise be as invested in sustainability, saying, I actually have this much revenue at risk, or, these large customers really want me to invest in sustainability. So I think the first part is just, thinking about kind of the language that you're using and the way these conversations are being framed, and how that's kind of different, maybe internally versus externally, depending on the stakeholders or audiences that you're dealing with. And then again, being able to kind of forecast or speak both the language of sustainability and the language of like risk or business benefit, and being able to kind of essentially translate between those two different areas to show how sustainability benefits the business, or how the business can get benefits from investing and doing more in sustainability.
And yeah, I'd like to add an insurance angle to that as well. I mean, you are right. And to the person who asked the question, you're right. There is a lot of politicization of this topic at the moment, and I completely agree with Chris that it's about the language that those of us in the sustainability use when we talk about this this matter as well. There has been a lot of hijacking, I guess, of the language of sustainability and ESG by a lot of people who don't really understand what it is. So ESG is just a framework for looking at sustainability risks. It's a little bit like if your car, if you had a puncture in your tire, you need to change the tire. Whether you do it on the side of the road with a jack and everything, or you take it to a mechanic and they've used their machine, you need to change the tire. That's the risk, because if you don't change that tire, the next time you go down the road, you're probably going to have an accident. So the means by which you measure or you change the thing itself is not necessarily what we need to be focused on. What we need to be focused on is that there is a risk, and insurance fundamentally is about risk. For us, we have no choice but to understand risk, measure it, manage it, price for it, because the risk is there. So whether we call it ESG or something else, or sustainability or transformation, it doesn't matter. The risk exists. The risk is continuing to get worse. So for us, it is part of our business model, if we want to continue to be insurers and remain in business for the future, to understand these risks that are emerging around the world, and to be able to quantify it and to be able to price for it, so that we can continue to provide insurance for our clients. The way that we do that, when it comes to talking to our clients and our partners, is by go into the materiality of the issue. So leave all of the, the politicization and all of the activism and all of that to one side and focus fundamentally on the risk. What is E about? E is about making sure that, for example, if you have a factory that you're insuring, is it next to a freshwater lake, or is it next to a community that could be impacted if they have toxic materials in the vessels? So what is the impact of that? If you're looking at the supply chain of a company, which is the S of ESG, what are the areas around the world that it's going through? Does it have to go through a war zone, for example? Is it going to be impacted by terrorists? All of these things then become important when you're looking at risk. And if it's a company's governance structure that is important, then you have to make sure that there's board accountability, that the people are doing the right things and following the right regulations. That has nothing to do with whether it's called ESG or something else. All it has to do with is good business sense and common sense. So I think for us, it's about making sure that whenever we have these conversations with our clients, we talk about the risk, and then we focus on what we know best as insurers and use that language to get our clients to see where we're coming from and what we're trying to do for them in helping them to mitigate their risk and, reduce the impact of those risks in future.
Thank you, Funké. There's a question from Davis, but I think you just replied to it because it was precisely about the financial benefit that the company can have, like when dealing with this kind of topics. Davis, if not, feel free to add and clarify in the chat. And so I would move to the next one from Luxmi. How does climate insurance thing works in countries like India or African countries where penetration is already quite low and climate risk is high and rising? And so how does this benefit people living in less developed economies?
So I'll take that. That's a really good question. And it's one of the core questions that I think about on a very regular basis. So yeah, penetration of insurance is not universal. In many places around the world, insurance is not something, it's not even just in India and Africa. It's a lot of places around the world that are not Europe or America. Maybe even in America, there's not, in some places, depending on where you are, there isn't that much penetration. It's not something that people really just do. So in the UK, where I live, you buy a house, you get insurance. It's just what you do because you're not going to get your mortgage without it. So I think for those places, it's about education, helping people to understand that at the end of the day, insurance is a force for good. Insurance is one of the oldest professions out there. It's basically about community pooling. And I think people forget that it's about the community coming together, putting bits of money together in a big pot so that when someone suffers a loss or a tragedy, they can have some of that pot so they don't have to bear it on their own. The community is supporting the individuals that are exposed to the most risk. When you strip everything away, that's what insurance is. So it's about explaining that to those areas where there is an insurance penetration, because in many cases these things exist anyway and community level. It's just insurance puts it into a structure that allows you to deal with bigger risks. So as we go into these regions and we're looking at things like parametric insurance, public-private partnerships, micro insurance, using that bit of penetration to increase the adaptation in those areas so that people then start to insure the bigger things as well. And again, understanding that it's about community-based protection rather than this, big corporations that everyone seems to be scared of. And I also think the other thing as well is the affordability of insurance. So in many of these places, it's not just about, whether insurance is available or even the type of insurance that is available. It's about being able to afford insurance. So insurance needs to be priced for the locals that are there so that it is affordable for them. There is no point having insurance if no one can buy it. So think about the risk there. Think about what is needs to be protected, and then find what is insurable and insure that. And insurance is not there to be a catch-all for everything. It's meant to be for those scenarios and those cases where, the community itself cannot bear it by themselves. So, or individuals cannot bear it by themselves. So the community can come in to help. That's all insurance is. So fundamentally, everything, the string that runs through everything I'm trying to say is education, educating people about the social good that insurance can do, and then using that as an avenue to build more on the types of insurance that are already in these regions. Hopefully that answered the question.
Thank you so much for your answer, Funké. So we have a lot of questions for you, but so we will jump to one for Chris to try to rotate a little bit. I think
I'm happy to just keep passing the mic. I mean, I think
No,
you're getting some great insights here.
To hear about your perspective. But one question for Chris, and I think it's more of a comment, but I think maybe you can provide some insights here. So we have a comment from Elena saying that internally she is framing all climate change impact risk about impact business assets and products when feasible. However, because of the climate change impact scenario, typically based on medium and long-term scenario, it can be difficult for a business executive to really let it sink in. So what would be your advice to talk to these executives to show them the value that it can have?
Yeah, it's a really good question. And I do think that there's a common tension in sustainability around organizations making like very short-term, predominantly financial-based decisions, whereas sometimes sustainability can feel a bit more abstract or a bit more long-term. I think, one sort of good starting place in general that we've seen work quite well, both with, clients and with partners and particularly in conversations with executives, is really trying to go through the process of like assessing the financial materiality of different business considerations on a short-term and long-term and also midterm time frame, and really like trying to dig into all of the different potential ways that a certain issue could like negatively impact, right, an organization. So if we just took like a basic example of, we have a specific plant or a specific facility that is processing XYZ, and this plant or this facility has a certain risk profile. You could think about what is the cost of insuring that plant now versus in the future. So like, what are your insurance premiums? If there was a work stoppage, what would be the financial consequences of that work stoppage? Could you shift production? How long would the work stoppage be? How much like CapEx is going into that site to potentially, deal with weatherization or modernization or other considerations? So this does get quite detailed, and it can be quite kind of time intensive or exhausting to do this. But we often find that if you like really go through kind of that checklist of like what are all the different financial dimensions that can potentially be impacted by climate change or climate risk, it often ends up adding up to be a number that is higher than I think most people realize, and I think higher than most executives realize, because they're not necessarily educated or thinking about risk and sustainability and climate exposure in these ways. So if there's ways that you can collaborate with teammates like finance or enterprise risk or operations or health and safety to, again, kind of put these cases together, if there's ways that you can do internal kind of stakeholder education, really kind of think through, kind of an exhaustive checklist of all of the different kind of financial dimensions, and then put together like a good analysis. Often you can show that, yes, there are like very significant midterm to long-term consequences to this, but actually maybe there are like also fairly significant short-term consequences that people didn't necessarily recognize or fully understand or grasp. And then obviously, again, there is the question, that often comes up around, how much would we need to invest now, and what would the return be, and what would the payback time frame be? Is this a 2-year return or a 3-year return or a 7-year return? Obviously, finance teams and CFOs consider things like this with energy efficiency measures and other types of investments. But yeah, I think the more that you can think about kind of the materiality, and particularly the financial materiality of all of these different areas across all of these different risk domains, and work with partners who, understand these different domains or these different levers or these different categories, you can often arrive at, I think, answers and insights and perspectives that are both interesting and compelling.
So, actually connected to this, there is a question for you, Funké, from Johnny. short-term and long-term. So you talked about the liability side of taking insurance product services to the insured sectors. Do you also actively reevaluate the investment portfolio on the asset side of the balance sheet? So how easy or difficult is to internally reshape a long-held investment in carbon-intensive industries?
Yeah, so Allianz, so I myself and Daniel work for Allianz Commercial, which is the insurance side. And then there's an investment side, which is Allianz Investment Managers who invest the premiums that are earned. And they are taking, as we're looking at what we're doing from a premium side, they're looking at what is happening to the invested premiums in terms of long-term assets that we've invested in and what types of assets that we have invested in and whether those assets are going to become stranded in future because of decarbonization and climate change, and whether we need to change our portfolio. So the same approach actually applies through the entire business about how do we change our mix so that our portfolio is more resilient for the future. It goes back to what I was saying before about insurance and an investment to an extent being about risk. If we have to take these decisions now, because if we don't take these decisions now, we're locked in for such a long time that by the time if we start taking the decisions too late, we are going to lose a lot of money. So for us, there is no choice. So yeah, we do look at it from both the short term, the medium term, and the long term perspective. On the insurance side specifically, there are clients that today we're saying, we can no longer do business with you because we think that in the long term, this is not going to be a viable client to have on our portfolio. And sometimes, we're able to talk to those clients and we understand what they're planning to do for the future. And those conversations themselves are actually a bridge to changing the mix for those clients themselves. So it's not so much that we're just saying yes, no, based on some, arbitrary numbers. It's about how can we actually change society? And I saw a question earlier about the role of insurers in society. How can we actually change society that we insure, so our clientele that we insure, by changing the way that they engage with transition? Because if they do the things that help them become more resilient, more sustainable, more environmentally friendly, that impacts what our portfolio looks like. So then our portfolio is more resilient, more sustainable, more environmentally friendly, which means that in the long term, it saves us, it makes us more efficient. It means that we pay less claims. It means that we save money. So from an insurer's perspective, we look at it across all sectors, across all time frames, because we can't kind of segment it on an annual basis, which is what you tend to see with insurers. And then the second part of the question is how easy or how difficult it is. Curious to know how easy or difficult that is internally with long-held investments. I think one of the better things that has happened in recent times within our company is that this policy about what we need to do has come right from the top. So we have to do it. So that's helped in many ways to kind of set the frame of what we can and can't do. That doesn't mean it's difficult to operationalize it when it comes to what we do within the businesses or even when we're talking to clients. That bit has been very, very difficult because different clients and different individuals even within the business are at different places when it comes to their sustainability journey. So it takes a lot of talking to people, explaining the details, going back to what I said right at the beginning. It's about moving away from this language of, if you're not recycling plastic or whatever it is, then you're destroying the planet, to this is about risk. This is about the stuff that you've always done, which is assessing risk and underwriting risk. It's just a wider lens with which to look at it. And this, we have to look at it through a wider lens because the world has changed. And what we could insure 10 years ago, 5 years ago, even a year ago, we can no longer insure in the same way. So this is about helping you to have a healthy book as an underwriter. So it's about having those conversations. It's not easy. It's difficult, but nobody said this was going to be easy, I don't think.
Thank you, Funké.
Thank you for your answer, Funké. We have a question for you, Chris, which is from Ali, which is maturity defined by probability of occurrence times expected impact?
So I'm also happy to let our insurance experts speak to this, but generally, in terms of kind of the framework or the language of enterprise risk, that is a very common way that a lot of companies would assess risk. So again, if we take sort of a basic example of, let's say we like run a shipping port, if we consider maybe two different risks, so one being like tariffs and trade protectionism, slows down the amount of shipping, and then maybe severe weather like damages or shuts down our port and prevents our port from operating. So those would be like the two risks that we've identified. And again, if we're thinking about climate risk, maybe we're thinking about severe weather. So if we said severe weather shutting down our port would have $10 million or pounds or euros in kind of aggregate or gross risk, but we assume that there's maybe a 10% probability of that happening, then you would say, okay, we have 10 million in like gross or aggregate risk, but maybe like 1 million in net risk because we just took 10 million and we multiplied it by 10%. So 10 equals 1. That's definitely a fairly common way that organizations look at this. So you can think about the probability or the likelihood of the risk. You can think about your ability to mitigate it. So, again, have you bought insurance? Or if something happens, are there other things that you can do, like, redirecting ships to a different port that might, again, mitigate the short-term damages? So there's these different kind of frameworks or these different, I guess you could say, like factors or considerations that allow you to work and model kind of your overall exposure versus what your net exposure might be. And this can become a little bit of an academic exercise, right? Like, is the probability 10%? Is the probability 15%? I think that can make it a little bit challenging or nebulous sometimes. But I think the important point is that, one, as we've kind of been discussing with kind of the world we live in now, particularly with a lot of these climate events, like the probability is not zero, like these risks will happen. And so it's worth kind of considering that fact. And then I think the better input data, the better modeling, the better forecasting you have, the more you can, again, hopefully assign things that seem credible and reasonable there to get to, again, more kind of precise or actionable numbers.
Chris,
Yeah,
sorry, if I could just ask, just as a follow-up to that question quickly, are there recommended frameworks that are more realistic or credible just in terms of use? So, is there institutional or regulatory or, countrywide risk frameworks which are generally accepted, which people would be expected to use?
I think the two that we would kind of recommend or we see most commonly used, or maybe three, would be one, the EU CSRD, so the European kind of FRAG materiality guidance for sustainability. And then you can either consider them kind of a pair or the same thing, but the TCFD ISSB kind of climate risk materiality framework. I would say most organizations are looking at their climate and sustainability materiality through one or both of those frameworks.
Great, thank you.
Yeah, I was gonna just add to the question on materiality and how it's defined. I think the way that we measure risk, and that's exactly probability of occurrence and the times the impact, that remains the same. What is changing is the probability itself. Everything is just more frequent, and the impact is more intense. So it's the again, going back to what I said before, right at the beginning, is none of the risk bit has changed. The way what risk is, how we calculate risk, it's just the way that these risks manifest and the numbers that come with it has changed so much that we can't keep doing things the way that we've always done things. So the key, going back to the discussion we had about language, was we need to be able to use the language that everybody understands and have always understood, but just say the numbers have changed. And when the numbers have changed, you have to change the way that you assess the whole pot that is available for everybody to draw from. So yeah, the fundamentals haven't changed. It's just the risk itself has gone up massively. And then actually the other thing I will add as well is what, it's not even so much, say, for example, when we talk about climate risk specifically, it's not the 1 in 1,000 year events and those things that are really, really rare. It's the fact that those really rare things are happening more frequently and they're having widespread impact. So they're like the wildfire in California. So that drives a lot of insurance claims payout. So that more than things like hurricanes even, because it's just so widespread and so many people are affected and it went on for such a long time and so many businesses were interrupted. Whereas when you have those singular nat cat type events, they tend to have singular effect. They're quite located, the location is small, but you have these things that just take up a lot of, like, literally whole regions being wiped out. The whole village we were seeing in the Swiss Alps yesterday, wiped out. So things like that were not heard of before are what are driving the cost of insurance and the way that insurers have to reassess what we think is insurable in terms of risk.
Thank you so much for your answer, Funke. We are getting to the end of the panel discussion. I'm sorry for the people who didn't get an answer to their question, but if you have more questions, you can also reach out to us or directly to Funke or Chris on LinkedIn or to myself or Daniele if you have more questions. So I would say what would be very nice is if you had a last statement or comment, Chris and Funke, that you would like the people who joined today to remember.
Yeah, I jump in. For me, it's about understanding that when it comes to sustainability, ESG, climate risk, all of those things, it's things that we've always lived with. And therefore, it shouldn't be new to anybody. So it's about framing it in the language that people understand that these are things that we've always dealt with, but it's the occurrence, the probability of occurrence that has gone up. So the things that we used to take for granted, we can no longer take for granted. Therefore, we have to think about them in the business decisions that we make as well. We can't ignore them because if you don't manage these risks will manage you. There is no getting away from it. So we need to do that. So that is the last thing, if anybody remembers anything I said today, if you don't manage the risk will manage you. So try and think about how you can manage them.
I don't know if I can top that, so maybe I'll just reaffirm it. But I completely agree that I think we just live in a world that is very different now. There obviously has been a lot of change, and there's social change, there's political change, there's technological change, but just fundamentally, like the weather of the Earth has changed. We're seeing more severe storms, we're seeing more weather-related and climate-related issues. And I think for a long time, businesses were largely able to kind of ignore those externalities or not necessarily think about it and kind of carry on as business as usual. And I just think the ecosystem around that, whether it's the physical risk or it's the insurance ecosystem or the banking and lending and investing ecosystem, like there are a lot of governments and organizations that sort of underwrite risk or control capital that just recognize the world is changing. And I think organizations that understand that and adapt to that and change along with it and sort of plan for those changes will be more successful and more resilient. And if you don't, then unfortunately, you're just going to have to deal with the consequences of facing these realities and facing these issues, essentially less prepared and with less planning and foresight and resources.
Thank you so much for this final comment, Chris. I also put in the group chat the link to our latest article about climate risk, in which we interviewed Funke, and Chris also gave some comments. So if anybody is interested in reading more about it and learning more about climate risk, I think this is also a very valuable resource from our newsletter. So I think we're just on time. So I would like to thank everyone. Thank Funke and Daniele from Allianz Commercial for joining us today. Thank Chris as well and Terra.do, who also enabled us to organize this panel today. And of course, to all the attendees for joining in today. So I wish all of you a great weekend. And thank you so much for joining us today. Bye-bye. Thank you.
Thanks, everyone. Bye. Have a great weekend.